Good morning, students. Welcome you all on the third part of India's 115. So, students, instead of three lectures, we are having four lectures on India's 115. So, tomorrow, there is also the entire schedule has been revised, and tomorrow we will not have a lecture on India's 16. Tomorrow, we will have fourth and the last part on India's 115 students. So, quickly in the next 2 minutes, we will recap the last two classes, and then I'll start with the agenda for today, right? So Ind AS 115, as the name suggests, revenue from contract with the customers. And in the first class, we understood very well what is the meaning of revenue, what is the meaning of contract, and what is the meaning of customers, right? So in nutshell, any contract with the customers, if that contract with the customers will give a revenue, then only it will cover under Ind AS 115, subject to some negative list or subject to some exceptions which we have read in the standard. Like if it is a leasing contract, then the revenue should not be covered under Ind AS 115. It should be as per Ind AS 116. Insurance contract, financial instrument, non-monetary exchanges, and certain transactions which do not give rise to a contract with the customer, like dividend, right? Then we have discussed with the help of a helicopter view example of air condition, installation, stabilizer, and maintenance service, that what are these 5 steps. The first one was identify the contract with the customer, and we also have understood that this is the first step. This is the entry step in this particular standard for making any for satisfying first step, which is identify the contract with the customer. Parties must have approved the contract and are committed to perform. Each party's rights are identifiable. The payment terms are identifiable. The contract should have commercial substance. It should not be like a artificial revenue and artificial cost, right? And there must be a probability to collect the consideration, and transaction price has to be there, or I would say the transaction price will be to the extent of probability of consideration, probability of collection of the consideration will be there, right? So we discussed step one, identify the contract with the customer, and for collectibility criteria, we have understood that a collectibility means there must be intention and ability to pay the amount, right? Then we have discussed the contract term. There must be a contract term in the contract. Then we have discussed when two contracts would be combined as a single contract. Then we have discussed what is the meaning of contract modification and what will be the accounting treatment of contract modification. Is it a new contract? Is it a separate contract? Is it a revision in the contract, or is it a updation in the contract, right? We have discussed that part also. Then after that, students, we have discussed the second step in the last class, which is identify the performance obligation. And we have discussed that this step is very important. Why? Because revenue has to be recognized when the performance obligation would be satisfied. If you are not aware about the performance obligation, how would you be able to know that whether the performance obligation is satisfied or not, right? Now, what is the performance obligation? Performance obligation is a distinct goods or services, is a different goods or services, right? Or in case of a services, or in case of a goods, a series of distinct goods or services that are substantially the same and have the same pattern of transfer, like newspaper, like security guard contract, like in case of electricity companies, right? So you are getting electricity on daily basis. Am I right? For example, today there is no electricity and there is power cut in Delhi. I'm just taking an example. So can electricity company will say that, oh, yesterday you have a power cut and there was no electricity, so today I'll give you more electricity and compensate yesterday's. Can electricity company say that? Or as a consumer, can you consume the electricity to the extent of 48 hours in 24 hours? Answer is no. So whatever services you have consumed, or whatever benefit as a customer you have consumed yesterday, or you were not able to consume yesterday, you will not be compensated today, right? So the point is when you are getting a electricity on a daily basis, electricity on a timely basis, so you are consuming the benefit of that services at that point of time, right? It means this service is a distinct goods or services. I'm not saying about the nature. You will say, sir, electricity is electricity, so it is not distinct. I'm not talking about the nature. I'm talking about the supply of the service and customer taking the benefit, right? And customer taking the benefit. I'm talking about that, right? For example, in my class, I am taking daily classes, and it is, let's say, it is a physical classes. So it is not a recorded classes, right? So in this case, the student who will come into in the last class, of course, he will get the benefit out of that class. The student who will come in the today's class, he will get the benefit out of today's class. So the point is, when there is a series of distinct goods or services that are substantially the same and having the same pattern of transfer, in that case, the revenue has to be recognized on a reasonable basis, on a reasonable time period basis. Like, you will get an electricity bill on a monthly basis, or in some states, or in some power companies, you are getting on a bi-monthly basis, right? You are getting on a 2 monthly basis, right? So we discussed a lot of things about performance obligation, and we discussed to identify whether the goods and services are distinct. We have discussed that you need to see one, from the goods and services aspect. Second, you need to see from the entire contract aspect, right? So first, you need to see from the goods and services aspect. For example, there was a supply of goods and there is a installation as well. So you need to see if the goods will be supplied, like if the air condition will be supplied, then even the customer can get it installed at his own, or the customer will get it installed with the readily available resources like outside mechanic. Okay, so it means the supply of AC and the installation is two different performance obligation, and the revenue has to be recognized. The revenue has to be recognized separately. When AC has been delivered, revenue has to be recognized to that extent. When installation will be delivered, then revenue has to be recognized for installation as well. So this was the from the goods and services aspect, right? Individually from goods and services. But you need also, you are required to see, is it distinct in the purview of the contract, why you have entered into a contract. Your objective is to avail air condition as well as installation. Your objective was not to get the installation from outside market. Your objective was to get the installation from this from this company only. Why? Probably that installation will require a high degree of integration, high degree of modification, customization, interdependency, right? So you want to get that installation service from that particular vendor, that supplier, or that company only. For example, we have also taken example of water purification plant. In case of construction services, right? Although we can get the services from different vendors, but the objective of the contract is to get the services by one particular person, so that he will able to know in construction, while doing the construction, he will be able to know where the holes or where the pipe of wire has been there, what is the sanitary fittings, right? So while doing the civil work, he will be able to understand very in a very clear manner that where I need to keep hole for, let's say, electricity fittings, where I need to keep hole for, let's say, for air condition, for split air condition soft, right? So my objective, or the customer objective, or the objective of the contract is to provide the entire services in one go from one company, right? So you need to see whether that goods and services is distinct from the context of the contract as well. And we have done a lot of examples, a lot of practical case studies on this aspect, right? Then we have also covered principal versus agent consideration, and we have discussed that in case of a principal, the principal has to recognize goods on a gross basis, has to recognize revenue on a gross basis. If it is an agent, agent has to recognize revenue on a net basis, which is a commission income kind of thing, right? Who is a principal? Principal is an entity who is having a primary responsibility for fulfilling the promise. Then you will say, sir, make my trip. So make my trip is not fulfilling the promise to fly the aircraft. So make my trip is never promised you to fly the aircraft, right? Make my trip has given you the right to fly, in the aircraft, right? So have you ever says that, sir, make my trip will fly the aircraft? Have you ever says that? But you have says that, sir, Air India will fly the aircraft, right? Indigo will fly the aircraft. So your expectation from Make My Trip as a consumer is only to get the ticket, right? Your expectation is not to your expectation is not that the make my trip will fly the aircraft, right? If something wrong happens, you will not abuse make my trip, you will abuse probably that particular airline company, right? You will not say, oh, I should not have to buy the tickets from make my trip. Make my trip has given you all the rights. When you buy from make my trip the ticket, when you buy the ticket from make my trip, so you can check, you can verify the ticket is a valid ticket, right? So who is a principal, who is primarily responsible for the fulfilling the promise? Second, who must have the inventory risk, and who has a discretion in establishing the prices, right? And for this we have also covered illustration number 26 to make you guys understand that concept, right? So friends, now let's move ahead with more concept in step 2. In step 2 I will discuss two concepts now, then I'll move on to the step number 3, right? So today we will discuss the concept of returns, right? Let me look at the query box if you guys have any query. Guys, I hope my voice is audible. Yeah. Yes. Good. It would be great if you will just respond by saying a good morning on that chat box or on that query box. I can see the response from Sumit. I can see the response from Rohan. Yeah, let's move on. Friends, in the last class, we were discussing about Amazon. For example, if Amazon is selling a goods on a right to return basis, right? So you are looking at the return policy. For example, if you have, I'll take a practical example. In last month, I have purchased an article from Amazon, right? And after 6 days, I have returned that article. Okay, because of some problem or some issues, I have returned that article. So Amazon, Flipkart, or even your local vendor has a return policy. So the point is, sir, let's say on 25th March, Amazon has sold for let's say in the month of March, from 22nd March to 28th March, Amazon has a big billion days sale. Okay. And Amazon has sold out a product worth rupees 50 crores or 100 crores. So every product was having a right to return. Every product was having a return policy for 15 days. Now the question arises, since the product was sold on 25th of March and every article was having a return policy of 15 days. So whether we should recognize a revenue for the year ending 31st March for this 100 crores, or whether we should not recognize any revenue for the year ending 31st March. So the first thing, that we will recognize revenue of 100 crores in 31st March. The second situation is we will not recognize any revenue, zero revenue for the year ending 31st March. Or the third situation is we should recognize revenue to the extent it is probable that we will collect it. It is probable that the return will not be there. So what could be the right thing to do? What could be the right thing to do? Recognize 100%, recognize 0%, and recognize some percent. Recognize to that extent where it is probable that goods are not going to be returned. What is the right thing? What is the right thing, guys? So if you will not recognize any revenue, entire revenue will shift to the next year, which is not correct, which will not reflect the true picture. If you will recognize 100% revenue, even that is not correct. Why? Because there is a right to return also, there is a return policy also. So friends, the right thing is to, on the basis of some best estimate, you have to recognize some percentage, right? You have to recognize some revenue where you are saying that where it is probable that the return will not be there. Sir, but how we will be able to know as a practical, if we will be working in some industry, or if we will be working in a company in a finance department, how we will do, right? In that case, in case of a provisioning, what you guys are doing, you are recognizing the provision on some best estimate basis. Okay, you are going to be recognized on some best estimate basis. How do you calculate best estimate? On the basis of past precedent. You have to see what is my past precedent, right? in the last 3 years, in the last 2 years, in the last 1 year, if I'm selling a goods worth X rupees, if I'm selling a goods worth 100 crores of rupees, then how much is going to be returned and how much, what is my experience? So let's say my experience is 5% or 10% of the goods will be returned after sale, right? So in this case, I have to recognize on the basis of best estimate basis. So probably I have to recognize 90 crores in the current year and 10 crore because I have received the money of 100 crores in the current year only. So I will recognize a revenue to the extent of 90 crores and I will recognize a refund liability to the extent of 10 crores. Sir, what will happen if in the next year or till the time of return period, if 10 crore has not been returned, only 6 crore has been returned, then I will update or I will actualize the revenue. I will not update, I will actualize the revenue. So I will recognize 4 crore in the next year and 6 crore I will refund. Sir, what will happen if instead of 10 crore, there is a return of 15 crores? So in that case, I will recognize a negative revenue in the next year for 5 crore rupees, right? But you need to recognize something on the basis of past precedent. Sir, if a company is a new company, then what is the past precedent? Then the company has to see the industry past precedent, industry pattern, right? Sir, if we are not aware about the industry pattern, then in that case, you have to make some estimate, 5%, 10%, 15%. Like every business have some estimate, right? You will even get the data that in case of online sales, how much is a data for return. You will even get the data as well, right? Are you getting me? So let's discuss this thing with the help of an example. Now the question arises, sir, if Amazon is selling a good with a return policy, whether this right to return is a separate performance obligation? Answer is no. Right to return is not a separate performance obligation, and that is why to the extent we are expecting the return, we are not recognizing the revenue. Are you getting me? So friends, Amazon is giving you two promises. One, Amazon is selling you goods and Amazon is saying if you will not like the goods, you can return the goods, right? So Amazon is also promising you the second thing. But the question arises, if these two are the separate performance obligation, answer is no. These two are the single performance obligation. If these two are the separate performance obligation, then of course, even though Amazon will recognize the revenue when Amazon will deliver the goods, right? But these two are not the separate performance obligation. These two are the single performance obligation, and hence Amazon will recognize the revenue only to the extent it is expecting that the return will not be there. The return will not be there. Clear? So let's understand this example. Let's understand this concept with the help of this example. A retailer has a stated policy that any product may be returned within 30 days. Okay. Based on the past pattern or precedent, 10% of the goods purchased are returned within the 30 days window. So basically, whatever it sold, 10% will be returned within 30 days window as per his past experience. On 15th March, the retailer enters into a new contract and sells 100 units costing INR 20 per unit at a price of 30 per unit, right? So what is my revenue? My revenue per unit is 30. My cost of goods sold is 20. My quantity of goods sold is 100, right? And what is my return percentage? My return percentage is 10%. The retailer is unable to assert that it is highly probable a significant revenue reversal will not occur for the variable component, that is the 10%. And the retailer is expecting that this 10% refund will be there, the 10% return will be there. How revenue needs to be recorded? Please tell me in this example how revenue will be recorded. Please tell me. I can see a lot of response now. Sumit, Koshiki, Hari, K, Rohan, Aniket, Radhika, Harshad, Jyoti, Himani. Yeah. So friends, first of all, please tell me how much money has been received by selling the goods. Of course, you will get the upfront money. So bank account debit 30, bank account debit 30 rupees per unit multiplied by 100 unit. So bank account debit to revenue 30 multiply 100, 3000, right? But Should we recognize revenue for this entire 100 units? Answer is no. So what should we do? First of all, what should we do? First of all, the entry which we have to make, what accounting entry we need to make? First of all, you have received the money, you have to receive the cash. You have to receive cash. So you have debited cash account debit. Cash account debit. By how much? So cash account debit by how much? 3000, which is 300, which is 30 minus 30 multiplied by 100. Right? But you need to recognize a revenue only to the extent of how much percent? Only to the extent of 90%, because you are expecting, as per the past experience, that 10% is going to be refunded. So you need to recognize a revenue to revenue, right? 2700. Two, the difference you have to recognize as a refund liability of 300, right? To the till the time this period will not be finished. Just a minute. 300. Okay, friends, so you have debited cash, you have credited revenue, and you have also stated a refund liability. So in your balance sheet, on the asset side, 3000 rupees cash has come. In your balance sheet, on the retained earnings, this 2700 has flown, and there is a refund liability of 300 also be there. But friends, if there is a refund liability, please tell me, if you will refund the money back to the customer, what is right you are having? If the customer is having a right to receive the refund of money, you will be having the right to receive the goods, right? Are you getting me? You have a right to receive the inventory. You have right to receive the inventory, right? So friends, in this case, what you will do? Second entry you will make asset account debit, inventory account debit, or let's say right to receive inventory. Right to receive inventory, right to receive inventory account debit. By how much? By how much? If you have sold 100 unit, 10% you are going to be recovered. So 10% means how much unit? 10 unit. 10 unit. So what is the cost of 10 unit? You will always recognize inventory on the basis of cost, not on the basis of selling price, right? So what is the value of the inventory for which you have a right to recover? So 20 multiplied by 10, 200 rupees. 200 rupees is the right to recover inventory. It is an asset. But friends, when you sold out on 15th March, you have sold out 100 units. So 100 units of inventory has gone out of your business. You are not having 100 rupees of inventory on 31st March or on 15th March. So you have to credit inventory. Like you have debited cash, one asset has come in for 3000. You have to credit inventory also. By how much amount? The value of the inventory is 20 rupees per unit. Total unit is 100. So you have to credit inventory by 2000 rupees, right? And you have to debit cost of goods sold. You have to debit cost of sales. By how much amount? You have to debit cost of sales by 1800 amount. So 20 multiplied by 90. So out of total 100 units sold out, you have credited inventory for 100 units. But out of that 100 units, for 10 units, you have debited right to recover the inventory. Second, for 90 units, you have debited cost to sales, because you are optimistic or you are certain that 90 units will not be refunded back, right? Is it clear? So this is how this accounting has to be made. So friends, you cannot defer the entire revenue till the time this return period will be elapsed. Rather, you have to make a best estimate out of it, right? So slightly it could be higher, it could be lower, but yes, you have to recognize the revenue. Why? Because you have satisfied the performance obligation, you have delivered the goods, and the entire goods is not going to be returned back, right? Is it clear? Is it clear, friends? I hope it is clear to all of you. This was a very simple concept. Sir, the return period was 30 days. and for example, after passing 30 days, no refund happens, then what will be the accounting entry? Then what will be the accounting entry? In that case, friend, you are having two things. One is refund liability asset, refund liability, and right to recover inventory asset. Then what you will do? You will reverse this entry. You will reverse this entry, right? What you will do? You will debit refund liability by 300 rupees. You will debit refund liability. You will credit revenue by 300 rupees. Likewise, you will credit right to recover asset by 200 rupees and you will debit cost to sell by 200 rupees. Right? I hope it is clear to everyone. These accounting entries are clear to everyone. This will be the accounting entry on 15th March. This will be the accounting entry on 15th April. The return period will be completed. Friends, now discuss a very important concept, options granting material rights. So in the last example, we have discussed the return policy. Now we are talking about the options granting material rights. Now we are talking about the discounts, right? So in the first example, we have talked about the return, right? When there is a return policy, then in that case, how to recognize the revenue. Now I am talking about the discounts, okay? Whether discount is a single separate performance obligation or a discount is not a performance obligation. And I'll give you 2-3 real life examples, right? Friends, 4 years back, I went to a Taj hotel, right? I went to Taj hotel. So when I booked a room in Taj hotel, so at that point of time, they were having their anniversary. I don't know whether it is 15th anniversary or 20th anniversary. So on that day, whomsoever guests were there, right? Like I was guest there, okay? I booked the room. So they were giving a 50% discount on the next booking. So any guest who has booked the room in that period, they were giving a discount of 50% on the next booking, right? And that is on the next, that is on the in that period only. So any guest who have booked a room in that period, he is entitled to a 50% discount voucher on the next booking, right? So friends, first please tell me, if I would not have booked the room at that point of time, whether I will get this discount voucher, whether I'm entitled to receive this right to discount in future purchases? Answer is no. Answer is no, right? Second example, again, this is a real life example. Few months back, I have purchased garments, or I have purchased apparels from Louis Philippe. And I purchased this product from Louis Philippe for 25,000 rupees, right? And Louis Philippe, normally I used to purchase the shirts and trousers from Louis Philippe. So they have given me a loyalty discount of 40% in the next purchases. In the current purchases, they have given me some discount, but in the next purchases, they have given me a discount voucher of 40%, right? That whenever you will come to our store, and if you will buy a product for X rupee, we will give you 40% discount. So friends, please tell me, if I would not have been purchased goods worth rupees 25,000 from that Louis Philippe store, whether I would be able to exercise this discount voucher of 40%? Answer is no. So in both of these examples, I have entered into a contract, right, initially, and then I got something for which I am entitled to avail some discount in future purchases. So for availing some discount in future, I have entered into a contract. I have taken some goods or services from this entity, right? Are you getting? Third example. Friends, there is a season sale, right? There is a summer season sale. There is a winter season sale. So in the month of December, you will have this sale, right? It will start around Christmas days, right? Or in the summers, it will start around June or July. So you will have a discount on every brands, everywhere there is a discount. Okay. So in the summer or in the winter season, any customer who will visit the store, he will get the 25% discount, he will get the 10% discount. So friends, for availing these discount, whether the customer has to enter into a contract in the earlier period, answer is no. Any customer who is visiting this store at the time of season sale, at the time of season sale, he will be entitled to that particular discount. That's all, right? So friends, in this example, he is not required to enter into the contract initially, then only he will get the discount. In case of season sale, it is not the case. Fourth example, I hope you all are using Zomato. I hope you all are using Zomato. Yeah, you all are using Zomato. So in Zomato, I was just looking that Zomato is saying you can, if you want to take a quarterly membership or half yearly membership. So what we will do? We will give you a discount of 10% or 20% on every food purchases, right? So if you will buy the Zomato membership, let's say worth 1000 rupees, you will get a discount on all the foods. You will get a discount of 20% or 10%, right? It means Zomato is selling you a discount coupon, and by way of selling that coupon, you will get a discount in future, right? So you have entered into a contract where you are getting an option granting material right to discount in future. So friends, in this case, the standard says that if by entering into a contract you are getting an option, why the word option has been used? Because it is at your discretion. And let me tell you, 4 or 5 years back I got a 50% discount voucher of Taj Hotel, but still I have not utilized that, and that has already been expired, right? Because I did not get the time to utilize that. Okay. So by entering into the contract, the customer is getting an option which grants a material right to discount in future purchases, right? So standard says that does the contract grant the customer the option to acquire additional goods or services? Please see, the word is additional goods and services. Additional goods or services. If the answer is yes, then that option is a separate performance obligation. Does the option provide a material right to the customer that it would not receive without entering into the contract? So if I would not have entered into the contract with Taj Hotel, I would not get the option to a material right to discount. I have not received an option to the discount of 50% in future purchases. If I would not have purchased goods worth rupees 25,000 from Louis Philippe, I would not have received a discount of 40%. But sir, as you told, even though at the time of season sale, or let's say we have seen some stores throughout the year they are giving discount throughout the year. Doesn't matter whether you have done earlier purchases or not, doesn't matter whether you are loyalty customer or not, throughout the year they are selling goods. Okay. So friends, in that case you need to see what is the additional discount I am getting by entering into the contract with the by entering into the contract with the entity, right? For example, 10% or 20% is a normal discount, and I am receiving a discount of 50%. So in this case, we have to recognize a separate performance obligation to the extent of 30%, which is my material right to discount, which is 50% minus normal discount 20%. So I need to recognize a separate performance obligation to the extent of 30%. So does the option provide a material right to the customer that it would not receive without entering into the customer? If the answer is yes, then you have to recognize that option as a separate performance obligation. If the answer is no, you are not required to recognize that discount voucher as a separate performance obligation, right? For example, in case of outright sale where there is a season discount, where there is a season sale and season discount, in that case, for example, goods worth rupees 100 is there and 25% is discount for everyone. So the entity is recognizing a revenue of 75%. That's all. The entity is not recognizing anything relating to the future discount purchase, future discounts. Okay. But if the entity is providing a discount voucher, in that case, entity is required to recognize this discount voucher as a separate performance obligation. Why? Friends, please understand. I have purchased a room from Taj Hotel for 10,000 rupees, right? And Taj Hotel has given me a discount of 50% for future purchases. What does it mean? And I have given 10,000 rupees to Taj Hotel. So let's say tomorrow, if I want to avail the discount and I went to Taj Hotel and I will say that I want to book a room, right? I have this discount voucher. So probably tomorrow Taj Hotel will charge only 5,000 rupees from me. Why? Because they have given me a 50% discount voucher. So friends, today Taj Hotel has received 10,000 rupees from me. Tomorrow Taj Hotel will receive 5,000 rupees to me. So for 2 nights of room booking, they have charged 15,000 rupees in total. Why? Because they have given me a discount voucher of 50%. So friends, don't you think that at the time of first sale, they have received a consideration of 10,000 rupees. At the time of second sale, they have received a consideration of 5,000 rupees. So don't you think they have received the consideration, some amount of consideration relating to the second sale in the first sale itself? So in the first sale, they have given you 2 promises. One, the first booking of the room. Second, they have given you the right to receive additional discount as a discount voucher in future. So it means they have received some revenue relating to future today itself. So they should not recognize the revenue relating to the future obligation, right? Let's understand this concept with the help of this example, right? Illustration number 23. And before this, let me quickly discuss option of material right to discount again in the Excel file. I hope my Excel file is visible, friend. I hope my Excel file is visible. Customer will be able to avail additional discount due to the fact that the customer has already entered into a contract by buying some goods and services earlier from the entity. Why customer is getting additional discount? Because the customer has already entered into a contract by buying some goods and services earlier from the entity. In this case, the additional discount which entity is expecting to provide in future purchases will be a separate performance obligation. The additional discount, friends, mind my word, additional discount. If Taj Hotel is giving a 20% discount to everyone and he has given me 50% discount, then what is the additional discount? Is it entire 50% or is it 50% minus 20%? It is 50% minus 20%. So 30% is the additional discount. So the additional discount which entity is expecting to provide in future purchases will be a separate performance obligation. Clear? Is it clear? So let's discuss this example to more understand this particular concept. An entity enters into a contract for the sale of product A for rupees 1,000. Okay. So what is the contract? Contract is sale of product A. Sale of product A is my one performance obligation. As part of the contract, the entity gives the customer a 40% discount voucher for any future purchases up to rupees 1,000 in the next 30 days. So the entity is also selling some discount voucher. Entity is also giving some discount voucher, not selling, giving some discount voucher to the extent of 40% from the next purchases, right? In the next 30 days. The entity intends to offer a 10% discount on all sales during the next 30 days as part of a seasonal promotion. Even though if this customer would not purchase this product A for 1,000 rupees, still everyone is entitled for 10% discount. But since this customer has purchased goods worth rupees 100 from this entity, so this entity has given a discount voucher of 40%. It means what is the additional discount entity has given to this customer? Only 30% is the additional discount. The 10% discount cannot be used in addition to the 40% discount voucher. So it is not 10 plus 40. It is not like that if anyone who is having this loyalty discount of 40%, he will get 10% additional. It is not like that. Okay. So the 10% discount cannot be used in addition to the 40% discount voucher, right? The entity believes there is 80% likelihood that a customer will redeem the voucher, and on an average, a customer will purchase 500 of additional products. Again, you remember in Ind AS 8, I have talked about the accounting policy and accounting estimate. So recognizing the revenue on the basis of best estimate is a policy, but measuring the best estimate is an estimate. So the entity estimates that, or the entity believes that there is a 80% chances that the customer will redeem the discount voucher and customer will come and avail the additional discount of 30%, right? 10% though I'll give to everyone, but this customer, there are 80% chances that this customer will come and avail the discount. And it is estimated that normally 500 rupees of additional product the customer will purchase. So normally from this discount voucher, 500 sale will be there in the future. So this is the entity estimates, right? Determine how many performance obligation does the entity have, and their standalone selling price and allocated transaction price. So the demand of the question is, first of all, question is asking about the performance obligation. So how many performance obligation is there in the question? There are two performance obligation: sale of product A, and the second one is the discount voucher. Discount voucher, or the right to receive discount in future. There are two performance obligations in this contract, right? So question is asking about the total. What is the total transaction price, friends? In this case, the total transaction price is 1,000 rupees. So the question is asking about that what will be the, out of 1,000 rupees, what will be the allocated transaction price for the sale of product A and the discount voucher So friends, let me solve this example in my Excel file. So friends, in this case, there are two performance obligation. Illustration number 20. How many performance obligation are there in this case? In this case, there are two performance obligation. Performance obligation. Shall I write it like a PO? Shall I write it as a PO? What is the performance obligation? Sale of product A, and discount voucher. These are the two performance obligations. Okay. Sale of product A and discount voucher. Clear? So friends, and what is my standalone selling price? What is my standalone selling price for product, for performance obligation? What is my standalone selling price? And what is my transaction price? Transaction price. So I need to calculate that. And for that, first of all, you need to determine what is my sale price. What is my sale? What is my sale value? My sale value is my sale price, or let's say transaction price. Price is how much? 1,000 rupees. Is 1,000 rupees. Okay. This is my sale price, or this is my transaction price. Now I need to calculate the value of discount voucher, right? What is my material right to discount? What is my material right to discount? What is meant by material right to discount? Material right of discount means incremental discount. Incremental discount. What is my incremental discount, friends? What is my incremental discount? My incremental discount is how much? How much? Please tell me. 40% rights this customer has got. 10% every customer will get, even without entering into the contract with the customer. So my incremental right to discount is 30%. My incremental right to discount is how much? 30%. Okay. Now, what is the value of this incremental right to discount? What is the value of discount voucher? What is the value of discount voucher? How will I calculate? Value of discount voucher is equal to expected purchases. Expected purchases. Value of discount voucher is equal to expected purchases. Expected purchases multiply by likelihood of purchases. Multiply by what? Multiply by likelihood for purchases. Multiply by material right to discount. Multiply by material right to discount. In this question, what is my expected purchase? 500 rupees. It is given in the question. What is my likelihood of purchases? 80% chances are there that the customer will come and customer will avail the discount. What is my incremental right to discount? It is my 30%. 500 multiply by 80% multiply by 30%. How much will come out? 500 multiply by 80% multiply by 30%. 120. So 120 is my value of discount voucher. So friends, if I'll talk about the standalone selling price, the product A price is 1000 rupees. Discount voucher is worth 120 rupees. The fair value of the total standalone selling price is 1120 rupees. What is my transaction price, friends? What is my transaction price? My transaction price is 1000 rupees. My transaction price is 1000 rupees. My transaction price is 1000 rupees, right? So now, how do I allocate the transaction price into my product and discount voucher? 1000 multiply by this divide by the total standalone selling price. So I have to allocate this transaction price in the ratio of standalone selling price. 1000 multiply by 120 divide by 107. Okay. Is it clear, friends? Is it clear? You remember the example of helicopter view example? Now, what will be the accounting entry? Sir, can you please suggest the accounting entry? At the time of current sales, what will be the accounting entry? What will be the accounting entry at the time of current sales? Cash account debit. What is cash account debit? Because you have received the entire 1000 rupees now. Cash account debit 1000 rupees. Two, revenue product A, sale of product A. How much revenue will be recognized from the sale of product A? 893. Next entry 2, liability relating to future discount, or you can say that unearned revenue as well, right? Unearned revenue 107. Now, how this liability will be knocked off? How this liability will be knocked off? At the time of future sale, at the time of future sales, sir, if this customer will not come in future, then at the time of future sales or after the discount is expired, right? If the customer will not come within 30 days, the discount will expire, right? In this case, what will the accounting entry? Liability relating to future discount debit. Liability relating to future discount debit. Okay. Credit. What will the credit? Credit revenue. By how much amount? 107. So either the customer will come and buy the product, or either customer will not come. So we will wait for the expiry period. When this discount will be expired, we will reverse the liability and will recognize the revenue. So this will be the accounting entry. Friends, I hope you guys have understood this illustration number 23 completely. Please let me know if you have any doubt in this. Please let me know if you have any doubt. Yes, Sumit, 40% includes 13%, and yes, 30% is the extra discount. If there is incremental discount, then only separate performance obligation will be recognized. You are right, Sumit. On which basis likelihood of purchase? It depends on the basis of past pattern, on the basis of past precedents, on the basis of past experience, on the basis of best estimate. Right, Sumit? Yes, Rohan. Like FMCG companies, right? So if I talk about what would I say? if I talk about these hotel companies, hospitality companies, if I talk about these retail companies like garments companies, if I talk about Big Bazaar, Reliance Digital, like these are giving a reward points, okay, which you can redeem from the next purchases. So they are not recognizing the entire revenue. They are not recognizing the entire revenue from that sale. Okay. So Avija is asking how much discount is allocated to the next purchases, sir. So Avija, we have calculated the total standalone selling price. So the value of the standalone selling price was 120, but the actual money you are getting is 1000 only. The transaction price is not 1120. The transaction price is only 1000 rupees, right? And that is why we have allocated 1000 in the fair value, in the proportion of standalone selling price. Okay. So the value of the discount voucher as per transaction price is 107 rupees only. So we have received 107 rupees relating to the discount voucher, right? And we have to allocate this 107 from the next purchases. Clear? I hope it is clear to all of you. Is it clear, friends? Thanks, Radhika. Sumit is saying crux is that at the time of issuing voucher, liability has to be recognized. You are right, Sumit. If there is a option to provide additional discount or material discount. Ashwini is asking what will be the second sales entry. So Ashwini is asking the second sales entry as well. Okay. So Ashwini, so for example, same customer will come for availing the discount. Okay, and buy goods worth rupees, let's say 1000. Okay. So friends, in this case, we have already received 1000 rupees. So instead of 1000, let me write it as a 500 rupees only. So friends, revenue worth 893 we have recognized out of 1000 rupees, but still revenue worth 107 rupees is going to be recognized. And this customer has come for availing the discount. So let's say at the time when discount is expired. Third scenario is at the time when the customer come for availing the discount and buy goods worth rupees 500. Then what will be the accounting entry? Now the accounting entry will be cash account debit, cash account debit, cash account debit to revenue from sales, cash account debit to revenue from, first of all, cash account will be debited by how much amount. So the customer has come for goods worth rupees 500, but he will not pay 500. How much money he will pay? So probably he will pay a discount. He will receive a discount of 30%, right? He will receive a discount of 30%, additional discount of 30%, or let's say he will receive an additional discount of 40%. So customer is buying a goods worth rupees 500, right? But customer will also receive a discount. And how much discount customer will receive? For example, customer will receive a discount of how much? Discount of 200 rupees, because 40% is the actual discount, right? So cash account will be debited by how much money? 300 rupees. Liability relating to future discount will be debited by how much? 107, which we need to recognize now, which we need to recognize now? Two, revenue. Revenue. How much revenue we are going to be recognized? We are going to recognize revenue of 407 rupees. We are going to recognize a revenue of 407 rupees, right? See, the next sale, the second sale is 500 rupees. The discount which is given to the customer is how much? 40%. So the cash collected will be how much? 300 only. 500 minus 40% is 300 only, right? Total discount. Total discount is how much? 500 minus 300 in these purchases. 100. But total discount is 200, right? But we have already recognized a liability of discount. We have already recognized a liability of future discount. How much discount we have already factored? How much discount we have already factored? You can see that in the first sale, the revenue has been recognized only for 893, not for 107, right? So liability already factored. Liability already factored is how much? The liability already factored is 107. Is 107, right? The liability already factored is 107. Okay. So additional discount, further discount is 93. And you can see that for 500 rupees of goods, there is a further discount of 93. There is a further discount of 93, and hence revenue has been recognized for 407 rupees only. So friends, with this customer, the total sale with this customer, the total sale, how much is the total sale with this customer? 1000 plus 500. 1000 plus 500. And what is the total collection from this customer? The total collection from this customer is 1000 plus 300. 1300 is the total collection from this customer, right? What is the total discount? Total discount is 1500 minus 1300, right? Because in the first purchases, the right to receive additional discount is given to this customer. Is it clear, friends? Is it clear? Yes or no? Is it clear? I hope it is clear to all of you. I hope it is clear to all of you. Ashwini, cash will not be debited by 500, na? I hope it is clear to all of you. Any doubt, any problem, any challenge? So I've given you all the scenario, right? When the time period will expire, when the customer will come and avail the discount, right? Good. So now let's move to the third step. Determine the transaction price. Friends, we have discussed in the last class, in the first class, we have discussed this in this helicopter view example. We have discussed these 5 steps in a very concise manner. We have discussed this 5 step, and we have discussed the step 1 was identify the contract with the customer. Step 2 is identify the performance obligation. Step 3 is determine the transaction price. It is very important to determine the transaction price. And let me tell you, normally the transaction price is given. Normally the transaction price is given, but the problem arises. The problem arises when there is an element of variable consideration. Like in this case, friends, in this case, for example, let's say, for example, if I am a contractor, right? I am a contractor and I'm entering into a contract with a customer that I will construct this building and I will take 10 lakh rupees. Okay. Now customer is saying that I need I want you to please complete the construction before Diwali. Why? Because I want to do the housewarming in Diwali. Okay. And this contractor is saying it is pretty difficult to complete this before Diwali. And the customer is saying, if you will complete the entire construction and hand over to me before Diwali, I will give you a bonus of rupees 2 lakh. I'll give, instead of giving you 10 lakh rupees, I'll give you 12 lakh rupees. Right? The customer is saying, please put your extra efforts and please complete it before Diwali. I'll give you 12 lakh rupees. So friends, what was my fixed consideration? My fixed consideration was 10 lakh rupees. Right? For constructing that house, it was 10 lakh rupees. But since I want a early delivery of that construction, early possession of that house, so I am ready to pay 200 rupees extra, 2 lakh rupees extra. Right? And this is known as a variable consideration. This is known as a variable consideration. And friends, the problem will arise in identification, or the problem will arise in the determination of transaction price when there is a variable consideration, and when there is a variable consideration. In case of FMCG, let me tell you, in FMCG business, for example, a big bazaar is entering into a contract. For example, big bazaar, or let's say there are a lot of retail chain outlets are there. A big bazaar has entered into a contract with ITC or contract with PepsiCo, right? That we will buy around 1 lakh unit of Pepsi bottles, right? So PepsiCo is saying, if you will buy 50, and let's say the per unit price of the PepsiCo bottle is 10 rupees. So PepsiCo is saying, if you will buy 50,000 units, we will give you a discount of 10%. I mean to say, PepsiCo is saying, if you will buy 50,000 units, we will give this bottle to you for 9 rupees. If you will buy 1 lakh bottle, then we will give you the discount of 20%, which is we will give you the bottle at 8 rupees. And we will give the discount on entire purchases, right? For example, if you will buy only 50,000 quantity, then entire purchases will be at 9 rupees. If you buy 1 lakh quantity, then this entire purchases will be at 8 rupees, right? So when the quantity or when the volume will go up, the discount will go up, right? So it means the discount is relating to the volume, and it is known as a volume discount. So friends, in this case, when PepsiCo will recognize a revenue, PepsiCo has to estimate this variable consideration. Variable consideration could be positive, variable consideration could be negative. Negative means PepsiCo has to give a more discount. So when PepsiCo sold the first 10,000 units, probably PepsiCo has sold for 10 rupees. Why? Because PepsiCo has to wait whether the customer will cross 50,000, customer will cross 1 lakh, right? So PepsiCo has billed at 10 rupees. But at the same time, PepsiCo will estimate whether the customer will be able to cross 1 lakh unit, whether the customer will be able to cross 50,000 units. So at the same time, the fixed consideration is 10 rupees, but the variable consideration is to give a discount of 1 rupee or 2 rupee. So at that time of determination of transaction price at inception, PepsiCo has to estimate the variable consideration, which is a discount, right? Which is a discount. Are you getting me? So friends, at the time of determination of transaction price, you have to look at the fixed consideration as well as you have to look at the variable consideration. You have to look at the variable consideration. Okay. So friends, transaction price should be fixed consideration as well as variable consideration. Okay. Now we will discuss some examples to compute the transaction price. Transaction price is an amount which the entity expects. You remember in step 1, we have discussed that the revenue is going to be recognized to the extent when there is a probability of collection of the consideration, right? When there is a probability of collection of the consideration. So transaction price is an amount which the entity expects to collect, in exchange for transfer of goods and services to the customer, excluding amount collected on behalf of third parties. Friends, First of all, let's say that contract price is rupees 10 lakh, right? And the expected collection is 6 lakh rupees only. What is the transaction price? What is the transaction price in this case? The contract price is 10 lakh rupees, but the entity is expecting to collect the consideration of 6 lakh rupees only. What is the transaction price in this case? 6 lakh or 10 lakh or some other number? 6 lakh, 10 lakh or some other number? Yes, Rohan, you are right. 6 lakh rupees, right? We have discussed this earlier also. The entity is required to recognize the revenue. The entity has to finalize the transaction price to the extent it is. There is a certainty of collection. Sir, what happens if subsequently 4 lakh will receive? So when the certainty of collection will arise for the additional 4 lakh rupees, the revenue will be recognized at that point of time. But as of now, the transaction price will be 6 lakh rupees only, right? Second example, the contract price is rupees 1000 and 18% GST has also been collected from the customer. Whether transaction price is 1000 or 1000 plus GST, which is 1118 rupees. So friends, what is the definition of transaction price? Transaction price is an amount which the entity expects in exchange of transfer of goods and services to the customer, excluding amount collected on behalf of third parties. So the entity is collecting a GST on behalf of the government. The entity has collected the GST and entity has to pay the GST to the government, right? So what is the transaction price? Is it 1000 rupees or whether it is including GST? Tell me. Friends, transaction price is Ashwini, not 1118. Transaction price is 1000 rupees. You have to recognize revenue, not of 1118. You have to recognize the revenue of 1000 rupees only. Okay. The contract price is rupees 1 lakh. The contract price is rupees 1 lakh. If the entity will deliver the product before contracted delivery date, the entity will get an incentive of rupees 50,000. Friends, the fixed consideration is 1 lakh rupees. But if the entity will deliver the product before delivery date, right, the entity will get an incentive of rupees 50,000. So this 50,000 rupees incentive, this 50,000 rupees bonus is a variable consideration. But the entity has a past history. The entity has a past history or past precedent that the entity has a past history of delivery before that date. The entity has always delivered before that date and estimate to receive a bonus of rupees 50,000. What is the transaction price in this case? So friends, I'll give you a real life example. I know a builder in Noida, right? I'll not take the name of the builder. So that builder is always delivering the flats before time, right? The builder always, what happens? The builder always factored the appropriate margin of time in construction of the flats, right? And that builder is not a debt-laden builder. That builder does not have any debt, right? The builder is working, or the builder is managing its entire operation. The builder is managing the construction entirely from whether its own pocket or from the customer's pocket or from the customer's money, right? And that is why the builder is always in a hurry to deliver as early as possible, of course, with the quality. Okay. Friends, the builder has a past history. The builder has a past experience to always deliver before the contracted delivery date. When you write in the agreement, so I purchase a flat from that builder, and in the agreement, the builder has given the timeline of 3 years, right? So I cannot tell anything to the builder if he will not deliver before 3 years, right? But he always have a past history of delivering before 3 years. So when I have entered into a contract, even the dealer has told me that don't worry, Mr. Garg, you will get the delivery in the next 2 year, next 2.5 years. Okay, don't worry, this will not be a 3 year because I know this builder, and you can see the past track record of this builder as well, right? And friends, of course, if I'm telling that if you will deliver me in next 2 years, I will give you 50,000 rupees extra. and this builder has a history of delivering before time. So friends, in this case, you have to estimate the transaction price at the inception of the contract. So whether you will say that the transaction price is only a fixed consideration or as well as variable consideration. The transaction price is equal to fixed consideration as well as plus estimated variable consideration. Estimated variable consideration. Transaction price is equal to fixed consideration plus estimated variable consideration. Clear? Fixed consideration plus estimated variable consideration. Clear? In this case, what will be the transaction price? The transaction price will be 1.5. The transaction price will be 1.5. Okay. I hope it is clear to all of you. I hope it is clear to all of you, friends. Sumit, the transaction price is, yes, you are right. It is 1.5 lakh. Himani, it is right. 1.5 lakh. Is it clear to all of you? Yes. Okay. So friends, coming to the transaction price, let me discuss some more examples here. So coming to the transaction price. Transaction price is of course a fixed consideration, and transaction price is depending upon the various factors, right? In addition to the fixed consideration, transaction price is depending on the various factors. Number one is of course a variable consideration. So in this aspect of step number 3, we are going to discuss these 4 aspects one by one. First one is variable consideration. Second, significant financing component. Significant financing component. Third, non-cash consideration. Non-cash consideration. Fourth, consideration payable to a customer. The entity is paying to the customer. Consideration payable to a customer. We will discuss this aspect also. Variable consideration, significant financing component, non-cash consideration, and consideration payable to a customer. So variable consideration we have discussed. 3 examples we have discussed for variable consideration. What is meant by variable consideration? Friends, what is meant by variable consideration? What is meant by variable consideration? Variable consideration means a consideration which is dependent on the future outcome or events. While estimating the variable consideration, all the constants needs to be considered. What is meant by constants? All the situations needs to be considered. All the restrictions needs to be considered. How to estimate the variable consideration? Now the question. Sir, in your third example, you have also included 50,000 rupees as a variable consideration. But what happens if tomorrow the builder will not be able to deliver before the contracted delivery date? In that case, this 50,000 revenue will not be there. Sir, what happens if Big Bazaar will not be able to pass on, will not be able to order 50,000 quantity or 1 lakh quantity to the PepsiCo, and PepsiCo has already estimated this variable consideration in their first sale itself, right? So friends, that is why it is important to estimate the variable consideration, right? Because this consideration is depending on the future outcome or future events, right? And that is why while estimating the variable consideration, you need to understand, you need to factor all the constraints, all the factors you need to consider, right? What is the past history of that customer? What is the past precedent or history of the entity, right? What is the market scenario, whether the demand is there or not? Is there any abnormal situation? So everything needs to be considered for estimating the variable consideration. And how to estimate the variable consideration, since it is depending on the future, and hence variable consideration needs to be estimated by 2 approaches. One is expected value approach. Expected value approach. And this is not a new approach. This approach is given in many standards. Like even in impairment standard, this approach is given. Expected value approach. This expected value approach is also known as probability weighted approach. Probability weighted approach. And the second one is most likely approach. Most likely, whether it will happen or it will not happen. Most likely approach. Probability weighted approach, or most likely approach. So when this probability weighted approach will be used, the probability weighted approach will be used whether there are multiple outcome of a single event. Example, there is a 10% chances that the entity will receive a bonus of 10,000 rupees. There is a 30% chances the entity will receive a bonus of 20,000 rupees. There is a 40% chances the entity will receive a bonus of, let's say, 50,000 rupees. There are 20% chances the entity will not receive any bonus. So for a single event, there is a multiple outcome. There are multiple probabilities. So in this case, probability weighted approach is required to be used. 10,000 multiplied by 10% plus 20,000 multiplied by 30% plus 50,000 multiplied by 40% plus 0 multiplied by 20%. So the total of this probability weighted approach will give you the estimate of variable consideration. What is most likely approach? Most likely approach will be used when there is a binary outcome. And there is a binary outcome. Example, there are 70% chances that yes, entity will be delivered before contracted delivery date, but there are 50%, 30% chances entity will not be able to deliver. What does it mean? It means the happening is more than 50%. The chances of happening is more than 50% in comparison to chances of non-happening of that event, right? So that is 30%. So friends, the binary, when there is a binary outcome, whether it will happen or it will not happen, most likely approach is required to be used. But when there is a multiple outcome of a single event, then expected value approach is required to be used. Okay. So friends, let's discuss this example. Let's discuss this concept with the help of some real life example and some practical case studies. So transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding amount collected on behalf of third parties. Variable transaction price reflect the effect of the following. Variable consideration including application of the constant. Application of the constant means you have to factor all the circumstances. Significant financing component, non-cash consideration, consideration paid or payable to a customer. We are discussing variable consideration. We will discuss all these concepts one by one. Okay. Transaction price may vary because of variable consideration, of course, right? So there are some common type of variable consideration like bonus, refund, volume rebate, incentive, discount, penalties, money back guarantees, price concession. There could be a various forms of variable consideration. Okay. So variable consideration will be estimated by expected value approach or most likely amount. Yeah. So friends, let's discuss this example. Entity enters into a contract and will receive a 1 lakh rupees of performance bonus if specified performance targets are met. So if some specified performance targets are met, then entity will receive 1 lakh rupees of performance bonus. Entity estimate 80% likelihood it will receive entire performance bonus and 20% likelihood it will receive none of the bonus. There is only a binary outcome of this event. 80% chances it will happen, 20% chances it will not happen. It will happen, it will not happen. There are not multiple outcomes. There are binary outcome. It will happen, it will not happen. Okay. So in this case, what is the best approach to estimate the variable consideration? The best approach to estimate the variable consideration is the most likely amount approach. So in this case, the most likely is happening of this performance bonus, that the entity will receive the performance bonus. So in this case, 1 lakh rupees of performance bonus is going to be included in the transaction price. Okay. Is it clear? Sumit, yes, variable consideration is contingent upon future event. That is why you are estimating now. So it is contingent. So today you are entering into a contract with a builder or a contractor that if you will deliver this house within 2 years, then I'll give you 50,000 rupees extra. So the builder is recognizing a revenue for fixed consideration, of course, when the life goes on. But he is also estimating the variable consideration according to the past precedent, according to the market scenario, right? So he's considering all those aspects. Even though in case of volume discount, if you will see the balance sheet of Hindustan Unilever Limited or ITC or these FMCG companies, right? They are giving volume discount and they are estimating the variable consideration, right, Sumit? This is required. Binary outcome means when an event has only binary outcome, means whether it will happen or whether it will not be happen, whether it is 1 or it is 0, right? So it is considered as a most likely approach. Binary means whether it will happen or it will not happen. Okay, so in this case it is written that 80% chances to happen and 20% chances not to happen. So when there are more than 50% chances of happening, it means it is more likely that it will happen, right? The chances of happening is more than the chances of not happening. Friends, now let's discuss a second example and we will be able to understand the expected value approach as well, probability weighted approach as well. Entity enters into a contract and will receive a performance bonus up to INR 1 lakh if it meets the specified performance target. It estimates the likelihood of achieving the targets as multiple outcome of a single event. And the bonus is up to INR 1 lakh. So possible outcome that the entity will receive 1 lakh rupees if the probability is 10%, right? If the probability is 10%. The entity will receive 80,000 if the probability is 30%. The entity will receive 60,000 if the probability is 35%. The probability of receiving 40,000 is 10%. And the probability of not receiving anything is only 15%. Now, in this case, there are multiple outcome. There are multiple outcome of a single event of receiving a bonus. So which is the best approach? Expected value is the best approach, which is probability weighted approach. So we will multiply A into B for calculating the probability weighted approach. And going by the probability weighted approach, 1 lakh multiplied by 10%, 10,000. 80,000 multiplied by 30%, 24,000. 60 multiplied by 35%, 21,000. 40 multiplied by 10%, 4,000. 0 multiplied by 15%, 0. This total is coming out at 59,000. Expected value approach is determined to be the best method. Entity calculates 59,000 using this method, right? So in this case, 59,000 has to be considered as a variable consideration, right? And entity is required to, whenever there is a variable consideration, on the every reporting date, the entity is required to reassess whether the variable consideration is still hold good or it will go up, go down, or it is okay, right? I hope it is clear to all of you guys. Entity enters into a contract and will receive a performance bonus based on the 5 potential amount if specified targets are met. The estimate of likelihood of achieving the target is as follows. There are 5 outcomes, there are 5 probabilities. So when you A multiply by B, it will give you the probability weighted approach, right? So in this case, this will be your estimated variable consideration. I hope it is clear to all of you, friend. I hope it is clear to all of you. Is it clear or not clear? Please tell me. Is it clear? Radhika is saying, yes, sir, it is clear. Srishti is saying perfectly all right, sir. Okay, friends, it's 8:24 now. Let's have a 10 minutes break. And after that, we will start the session again. So let's have a 10 minutes break and we will start at 8:34. Okay. Yeah. So welcome again, friends, after the break. And let's discuss this example number 4 on variable consideration quickly. Company A supplies components to industrial customers. The contract stipulates that the price per component will decrease as sales volume increases, right? So it is again a case of volume discount. It is a case of volume discount. Whenever the volume will go up, the price will go down. The price applicable for the entire sales will be based on the sales volume bracket, right? And here, the volume relating to rebates, the volume related rebates is given in this question. So 100 rupees, CU means currency unit. 100 INR will be charged per unit if the sales volume is between 0 to 10 lakh units. If the customer will purchase up to 10 lakh units, the entity will charge a price of 100 rupees per unit. If the customer will purchase more than 10 lakh units, but up to 30,000 units, the entity will charge 90 rupees. The entity will give a discount of 10 rupees and entity will charge 90 rupees. If the customer will give an order of more than 30 lakh units, the price per unit will be charged for 85 rupees per unit, right? So price applicable for the entire sale will be based on the sales volume bracket, right? How is revenue estimated under Ind AS 115? Friends, if it is up to 10 lakh units, the entire sale is recognized at 100 rupees. 100 rupees means 100 rupees per unit. If it is from 10 lakh to 30 lakh units, the entire sales has to be recognized at 90 rupees per unit. Okay. If it is more than 30 lakh units, the entire sales has to be recognized at 85 rupees per unit. So when the entity is making a sale to this industrial customer, the entity has to estimate the variable consideration. And variable consideration means it could be positive, it could be negative. The entity has to consider the volume rebate, the volume discount. Entity has to factor in the beginning that what will be my price per unit, which I have to recognize in my books of accounts as a revenue. So in this case, since there are range of possible outcomes, since there are multiple outcomes, so which is the best suited method? The best suited method is probability weighted approach, right? And what is the probability? What is the probability? The probability is also given, let's say, in this question, the probability is given like 10% for, and let's say there are range of possibility given, and the information which is given in the question is 10% probability is there that there will be 8 lakh of units. 8 lakh units will be sold to this customer, right? So if 8 lakh units will be sold to the customer, then what will be the price? 100 rupees will be the price. So these are the information which is given in the question. Okay. So friends, 10% probability is there that the sales volume will be 8 lakh units. If the sales volume will be 8 lakh units, then the price would be 100 rupees. 70% probability will be there. 70% probability is there that the sales volume will be 2.5 million units, 25 lakh units. And if it is 25 lakh, the price will be 90 rupees per unit. 20% probability is there. There will be 35 lakh units of sale. And if it is 35 lakh units, it will come under the bracket of 85 rupees. Okay. So this is total 100%. These are the units probability. These are the prices. So first of all, what is your probability weighted sales value? Probability weighted sales price. Your probability weighted sales price is 10% multiply by 8 lakh multiply by 100. 70% multiply by 25 lakh multiply by 90. 20% multiply by 35 lakh multiply by 85. So this will give you an entire, on 100% probability, this will give you a sale of 22 crores 50 lakh rupees. Now, what is my probability weighted sales volume? My probability weighted sales volume is A multiplied by B. This is A, B, and C. So this one is A multiplied by B multiplied by C. And this sales volume is A multiplied by B, right? So my probability weighted sales volume is 10% multiplied by 8 lakh, which is 80,000. 70% multiplied by 25 lakh, which is 70 lakh 50,000. 20% multiplied by 35 lakh, which is my 7 lakh. Okay. Clear? So the total probability weighted sales volume is 25 lakh 30,000 units. and the total probability weighted sales value is 22 crore 50 lakh rupees. So if my total sales price is 22 crore 50 lakh and my total probability weighted sales quantity is 25 lakh 30,000, so I can get a per unit price. I can get a per unit price. Okay. So what will be my per unit price? My per unit price is 22 crore 50 lakh divided by 25 lakh 30,000. This will give me a price of 88.93 rupees per unit. So friends, the average unit price is 88.93, right? So friends, in this case, revenue has to be recognized at 88.93 rupees from the contract. Okay. But sir, initially if the customer have paid 100 rupees at the rate of 100 rupees, then what will happen? In that case, a refund liability has to be recognized, and unearned revenue has to be recognized to the extent of 11.07 rupees, which is going to be adjusted in the subsequent sales, okay? Because you will receive at the rate of 100 rupees, you will recognize a revenue to the extent of 88.93 rupees. So you have to recognize a credit, which is a refund liability to the customer for 11 rupees 7 paisa per unit. Okay. Is it clear? Which is going to be restated, which is going to be reassessed at every reporting date. Clear? Is it clear, friends? Now let's discuss the same example with a different approach, most likely approach. A believes that the total sales volume for the year will be 2.5 million based on the past experience and forecasted sales, right? So A is believing that the 25 lakh unit is the most appropriate quantity. So based on the most likely method, the transaction price is calculated as, if we are expecting that the customer will give an order for 25 lakh unit, what is my price per unit? In the bracket of 25 lakh unit, which is 10 lakh to 30 lakh, the applicable price is 90 rupees. In this case, we will multiply by 90 to 25 lakh units. It will give us 22 crore 50 lakh rupees in total. So what is my average unit price? My average unit price is 90. So friends, in this case, the revenue has to be recognized at 90 rupees. But sir, for the first 10 lakh unit, probably we had received 100 rupees per unit. So in that case, refund liability has to be accrued for 10 rupees per unit. So bank account debit at the rate of 100 rupees per unit, to revenue at the rate of 90 rupees per unit, to refund liability at the rate of 10 rupees per unit. So this is how this accounting of transaction price has to be done. Is it clear, friends? I hope it is clear to everyone. Sumit is asking, sir, what if customer demand refund of 11 rupees 7 paisa per unit? I think Sumit wants to say that, sir, instead of getting it adjusted into the subsequent sales, customer is demanding the money. Sumit, generally what happens, right, in case of a volume discount, this is going on as a running account, right? Because the entity will say that you have to order to a particular quantity within a year, within a calendar year, within a quarter, within a specified period of time. So normally companies wait till that period of time, right? For example, today we are estimating a variable consideration, and again it is depending on some future outcome or future events, right? So we cannot say that we are going by the probability weighted approach. So we are certain that yes, it will happen. But what happens if it will not happen, right? In that case, we are not going to provide any refund to the customer, right? So in this case, practically companies do not provide any refund to the customer. Practically companies wait till the time period, till the expiry of the time period. Yes, if the customer will be able to reach to that volume on which he is entitled for a discount, in that case the companies will either adjust from the subsequent sales, or the company will give the refund as a money to the customer, right? But if you are saying still customer is demanding the money and entity is paying the money, then what will happen? Doesn't matter. The company will pay the money to the customer. So the accounting entry will be cash account debit to revenue to refund liability to bank, to cash to the customer, right? But if the customer will not be able to reach at that volume, in that case, customer has to pay subsequently at the rate of the initial price. Okay. In that case, customer has to pay again. Soham is asking, sir, got it. But when will we recognize the revenue in case of early delivery? Original performance obligation or delivery date? So Soham, please tell me one thing. Revenue has to be recognized when the performance obligation is satisfied. For example, if Amazon has, when you have ordered a product with Amazon, it was showing as a delivery date of, let's say, 15th of April. And you have received a delivery on 31st March. Now you tell me when the performance obligation has been satisfied. Is it on 31st March or whether it will be on 15th April? Performance obligation is satisfied when the goods have been delivered to the customer. The customer is ready to consume those goods and services. The customer is able to get the benefit out of those goods and services. So in this case, it is the date of early delivery when this performance obligation has been satisfied. It is 31st March. So I believe you got your answer, Soham. Sumit is saying, sir, in binary outcome, only two situations can be there. It will happen and it will not happen. That is why it names most likely approach. You are right, Sumit. Bang on. You are right. So I have responded to all the queries of participants. Let me know if you have any queries. Otherwise, I'll move on. Yes. So friends, let's discuss illustration number 30. And in this illustration, we have a mix of both expected value approach as well as most likely approach. Okay. AST Limited enters into a contract to build a manufacturing facility. AST Limited enters into a contract with a customer to build a manufacturing facility. The entity determines that the contract contains one performance obligation satisfied over a period of time. Okay. The construction is scheduled to be completed by the end of 36th month, by the end of third year, for an agreed upon price of rupees 25 crores. So guys, this is the fixed consideration. This is the fixed price. What is the fixed consideration? The fixed consideration is 25 crores. 25 crores. The entity has the opportunity to earn a performance bonus for early completion as follows. In spite of a fixed consideration, there is an element of variable consideration as well. 15% bonus of the contract price if completed by the 30th month. So if the entity, if the AST Limited would be able to complete by 30th month, the entity is entitled to a 15% bonus, 25 crore multiplied by 15% bonus if it is able to complete by 30th month, and there is a chances of 25% to avail this bonus by this entity. 10% bonus if completed by 32nd month, and this entity is entitled to 25 crore multiplied by 10% if it will be able to complete the construction by 32nd month, and there are 40% chances to complete this construction by 32nd month. The entity is entitled to a 5% bonus if completed by 34th month, and there are 15% chances. So 25 plus 40, 65 plus 15, 80, and nothing is given for 20%. It means 0% chances. It means 20% chances that the entity will not receive any bonus. In addition to the potential performance bonus for early completion, AST Limited is also entitled to a quality bonus of rupees 2 crore if a health and safety inspector assign the facility as a gold star rating as defined by the agency in the terms of the contract. AST Limited concludes that it is 60% likely that it will receive the quality bonus. Determine the transaction price. So friends, in this question, a fixed consideration has been given, and there are two variable consideration. One is relating to the performance bonus, and the second one is related to the quality bonus. And you will see that for performance bonus, multiple outcome is given. For the performance bonus, multiple outcome is given, and for the quality bonus, only binary outcome is given. You can see that 15%, 10%, 5%, 0%. There are 4 outcome for performance bonus, and for quality bonus, the amount is 2 crore, and it will be received only when the health and safety inspector will give this facility a gold star rating. And there are 60% chances, there are more than 50% chances that it will receive the quality bonus. Now we need to determine the transaction price. We need to determine the transaction price. So what is my transaction price? My transaction price is fixed consideration plus estimated variable consideration. In case of performance bonus, going by the which approach? Expected value approach, probability weighted approach, and for quality bonus, going by the most likely approach. So what is the revenue in this case? In this case, 15% chances is that we will receive, 25% chances is that we will receive 15% bonus. 15% of what? 25 crore multiplied by 15%, which is 3.75 crore. 25 crore multiplied by 10%. 25 crore multiplied by 10%, which is 2.5. 25 crore multiplied by 5%, which is 1.5. And 25 multiplied by 0, which is 0. So going by the probability weighted approach, this is giving me 2.125 of performance bonus. And going by the most likely approach, my quality bonus is 2 crore. So what is my total consideration? This is my total transaction price. My total transaction price is fixed consideration, which is 25 crore, plus performance bonus, which is my 2.125 crores, plus quality bonus, which is my 2 crore, and the total is coming out at 29.125 crore. This will be my transaction price on the basis of variable consideration. Is it clear? Any doubt so far? Any doubt? Is it clear, guys? I hope it is clear to all of you. Good. Friends, let's discuss next concept, which is your significant financing component. So we have discussed the variable consideration. Now discuss significant financing component. What does it mean? What does it mean? Significant financing component. For example, X Limited has bought a machinery from Y Limited. And X Limited asked, what is the price of this machinery? So Y Limited told that the price of this machinery is, let's say, 1 crore rupees. Okay. So X Limited told Y Limited that Mr. Y, I don't have money right now. And I want to buy this machinery, and I will give you, so I can give you some sort of, guarantee and all, and I'll give you the money after 1 year. Right. Then then Y Limited told to X Limited that Mr. X, okay, don't worry, I'll sell this machinery to you. But instead of 1 crore rupees, the price is not 1 crore rupees, the price is 1 crore 10 lakh rupees. So friends, earlier the price was 1 crore rupees. In the moment X Limited has told that I will not be able to pay right away, or I will not be able to pay within the normal credit period. X Limited, whenever X Limited has told these facts to Y Limited, suddenly Y Limited has told, okay, the price is not 1 crore rupees, the price is 1 crore 10 lakh rupees. So friends, now the question is, why Y Limited is asking 10 lakh rupees extra? Why Y Limited is asking for 10 lakh rupees extra? Friends, Y Limited is asking 10 lakh rupees extra because of time value of money. If X Limited would have paid right away, Y Limited will use that money into the business, or even though if Y Limited will deposit that money into the bank, Y Limited will get an interest, right? Since X Limited is not paying right away, X Limited is paying after 1 year. In that case, somehow Y Limited is funding to the X Limited by giving the machinery to the X Limited probably, or you can say that Y Limited has given a loan to X Limited, and in turn X Limited has purchased a machinery from that loan. Okay, and now X Limited has to pay that loan to the Y Limited after 1 year. So in this case, whether the transaction price is 1 crore 10 lakh rupees or the transaction price is 1 crore only. Tell me, what is the transaction price? What is the transaction price from the contract with the customer? Transaction price is not 1 crore 10 lakh rupees. You're right. The transaction price is 1 crore rupees only. And what is this 10 lakh? This 10 lakh will be the interest income which has to be accounted for as per Ind AS 109. Right? So the transaction price from the purview of Ind AS 115 is not 1 crore 10 lakh. It is 1 crore rupees only. Are you getting me? It is 1 crore rupees only. Friends, significant financing component arises and there is a time value of money, and in the standard there is a rebuttable presumption that whenever the time difference between the delivery of the goods and services, I mean to say, whenever the time difference between the satisfaction of performance obligation and the receipt of money is more than 1 year, then only we are required to calculate the finance component. Then we are required to calculate the significant financing component. So the finance component is a difference between the price of the goods and services transferred, I mean to say consideration received by the entity, and the goods and services transferred to the entity, right? So it is a difference between the price of the goods and services transferred and the actual consideration received, right? And the actual consideration received. Okay. So what is the price if the goods and services has to be sold right away? Okay. And if the difference between the goods and services transferred and the amount received is more than 1 year, then only finance component will arise. And the finance component is the difference between the price of the goods and services transferred and the actual consideration received. Like in this case, the price of the goods and services is 1 crore only. And the actual consideration received is 1 crore 10 lakh rupees. So the difference is 1 crore 10 lakh minus 1 crore is 10 lakh rupees, right? Sir, whether significant financing component is always an income, it could be a cost also. For example, the customer is paying in advance. The customer has, for example, the customer has paid to the entity in advance, and the entity has said that I will only be able to deliver after 2 years, right? For example, let's say the defense ministry, or let's say the Indigo airline is buying an aircraft from the Air Boeing, okay, USA, and they are paying upfront 20 crore rupees. They have paid upfront, and the Boeing is saying that it will take around 1.5 years to manufacture this aircraft, and we will deliver only after 1.5 years. So customer is paying upfront, and they will deliver after 1.5 years. It means there is a difference of more than 1 year between the amount received and the goods delivered, or the performance obligation satisfied. So it means there is a requirement to calculate the significant financing component. Why? Because this time value of money is there. So friends, in this case, the customer has paid 20 crores to the entity. So what does it mean? Whether the value of the goods and services is 20 crores? So in a way, when the customer is paying in advance, the customer is funding the operation of the entity, right? If the customer would not have paid, probably the entity would have to take a working capital loan, or the entity would have to take a term loan to manufacture and to deliver the goods and services. And when this customer will pay back to the entity will pay the loan of the entity will pay its loan, right? So friends, if a customer is paying in advance this 20 crore rupees, so probably the revenue is not 20 crore rupees. Probably if the entity will deliver the goods and services today, right? So probably the amount would be of 22 crore rupees or 21 crore rupees, right? So the right away, the price is 21 crore rupees, but the entity is delivering the goods after 1.5 years, and customer is ready to pay upfront. So they are asking for a less payment, which is 20 crore rupees. So it means 1 crore rupees is a finance cost to the entity. The top line will be 21 crore, the revenue will be 21 crore, and 1 crore will be the interest cost, right? So if customer is paying in advance, there will be an interest cost. If customer is paying as a deferred payment, there will be a interest income, right? Is that clear? So friends, time value of money is there, right? If the and when can we say that the time value of money is there? We can say that the time value of money is there when there is a difference between the consideration received and the transfer of control of goods and services for more than 1 year. The finance component is the difference between the price of the goods and service transferred and the actual consideration received. Okay. There is a difference between the time of consideration received and transfer of control of goods and services for more than 1 year. Only then it is required to calculate the finance component. Right? And finance component has to be calculated on the basis of interest rate. And interest rate should be the market rate of interest. Interest rate should be a market rate of interest. Market rate of interest. Okay. Interest rate should be a market rate of interest. Clear? For example, the market rate of interest is let's say 10%. Okay. The market rate of interest is let's say 10%. Rate of interest is 10%. Entity will receive the consideration of rupees 121 after 2 years. Calculate revenue. Friends, the entity will receive the consideration after 2 years and the entity has sold goods right away. What will be the revenue? If in this case you have to calculate the present value factor. So your amount is 121. Your present value factor at the rate of 10%. What is my present value factor at the rate of 10% for 2 years? It will be 1 divided by 1.1 again divided by 1.1, right? So this will be 0.8265. What is my present value? My present value is 121 multiplied by 0.82645. This will be my present value. Okay. What will be the accounting entry? Accounting entry will be customer account debit or trade receivable account debit. Customer account debit by how much amount? 100 rupees. Okay. To revenue at the time of satisfaction of performance obligation. Right? At the end of the first year. This is at the time of sale. At the end of first year. Customer account debit to interest income. What was the interest rate on which we have done the discounting? It was 10%. 100 multiplied by 10% is your interest income which you have to recognize at the end of the first year. Again, at the end of the second year. At the end of second year. What is my customer account is debited by how much amount? What is my interest income? My interest income will be on this 100 plus 10 because nothing has been received so far. 100 plus 10 multiplied by 10%. So it will give me 100, 11. 11 rupees interest income has to be recognized in the second year. Now what will be the next entry? At the time of collection. Cash account debit to customer account. How much money we are getting? We are getting 121. So this customer account will be nullified. Okay. So these are the accounting entry in case of significant financing component. I hope it is clear to all of you, friends. I hope it is clear to all of you. Yeah. So let's discuss an example to understand these three situations in more detail. Example. The entity has sold goods worth for rupees 1,000, for rupees 10,000. Yeah. Now I'm taking three scenario, right? There are three customers, customers A, customer B, customer C. Customers A, B, and C. Okay. In case of a first customer, the entity has received a upfront revenue of 10,000. Consideration is 10,000. So the entity has sold goods worth rupees 10,000. Entity has received a consideration of rupees 10,000. Okay, from a customer. Now, how much revenue is going to be recognized? How much revenue is going to be recognized? Revenue, interest income, interest cost. Interest income, interest cost. Okay, remarks. Friends, in this case, what is my revenue? My revenue is 10,000 only. No interest income, no interest cost. There is no interest income. There is no interest cost. And what is my remarks? What is the remarks? Remarks is paying upfront. So customer is paying upfront. Okay. Is it clear? Soham, is it clear? Koshiki, is it clear? Sumit, is it clear? Is it clear, friends? Paying upfront. Okay. Clear? Now, the second example is the customer is paying after 1 year. The customer is paying after 1 year and the customer is paying 12,000 rupees. The customer is paying 12,000 rupees. Why? Because the customer is paying after 1 year. Paying after 1 year. The customer is paying after 1 year. The customer is paying after 1 year. Tell me what is my revenue in this case? Tell me what is my revenue in this case? Tell me what is the revenue in this case? The revenue is, of course, the revenue is an amount. Revenue is an amount which is going to be received by way of sale in the ordinary course of business. So what is the amount? What is the price if this goods and services has to be sold in a normal credit period? Or let's say if it has to be sold upfront. So by way of selling a goods upfront, entity would have recognized a revenue of 10,000 rupees. And why this entity is getting 12,000 rupees from customer B? Because the customer B is delaying in the payment. The customer B is not paying upfront, right? Somehow there is a financing element which is involved in this particular transaction. So we are thinking from the revenue perspective. We are not thinking from the recipient of services perspective. For example, what B will make an accounting entry. So probably if B is recognizing of B is purchasing such goods and services, so probably B will recognize the expense as a 10,000 for that particular goods and services, or B will recognize 2,000 rupees as a finance cost, right? Or if B is purchasing, if the B is purchasing an asset, right? For example, this entity is recognizing a revenue from the sale of a, let's say, machinery, and that machinery is an asset for B. So what B will do? B will capitalize that interest cost. So for B, the value is 10,000 plus 2,000. If that machinery is a qualifying asset. If that machinery is not qualifying asset, for example, you all have seen that we are purchasing electronic items on a EMI basis. For example, B has purchased a car on EMI basis from the dealer itself, and the price of the car is 10 lakh rupees. But since B is not paying upfront, so the dealer is taking 12 lakh rupees from B. So dealer will recognize a revenue of 10 lakh rupees as a normal revenue from operations, and 2 lakh rupees dealer will recognize as a 2 lakh rupees dealer will recognize as an interest income. What B will do? B will capitalize, since this car, when B has purchased the car, that car was available for immediate use in the present condition. So that car was not a qualifying asset. So B has to capitalize that car at interest cost as a finance cost in the P&L. So that was a B treatment. But here we are talking about the treatment in the books of the entity which is selling the goods or providing the services. Are you getting me? Are you getting me, guys? Sumit, I hope you got your answer as well. Yeah. Sumit, it is not going to be added in the car. Please try to understand. You need to see if car is a qualifying asset or not. Car is not a qualifying asset. If it is a qualifying asset, then it has to be added as per Ind AS 23. If it is not a qualifying asset, then it had to charge. It has to be charged to the P&L. Okay. This is the concept as per Ind AS 16 and Ind AS 23 as well. I hope it is clear, Sumit. Good. Friends, now the third situation. The entity has received 9,000 rupees from a customer. This particular goods and services which is customer C. Why? Because customer is paying in advance. Paying in advance of 1 year. Paying in advance of 1 year. Right. So friends, now tell me, since the customer is paying in advance, what does it mean? It means the customer is funding the operation of the entity. The customer is facilitating the advance money to run its operations. So what does it mean? It means the customer has given a loan to the entity. And revenue has to be recognized at the normal price, at the standalone selling price. What is the revenue? What is the revenue in this case? The revenue in this case will be the 10,000 rupees is the revenue in this case. Now, what will be the interest income? There is no interest income. The entity has to recognize an interest cost of how much money? Interest cost of how much? 1,000 rupees. Entity has to recognize an interest cost in this case. Is it clear, guys? Is it clear, friends? I hope it is clear to all of you. I hope it is clear to all of you. Concept of significant financing component. Now tell me one thing. If a customer is paying in advance, if a customer is paying in advance to secure the order, whether it will tantamount to significant financing component for the entity. Example, Mr. Ram wants to buy Mahindra XUV 700 and he pays a booking amount of rupees 50,000. The car will be delivered after 1 year. Friend, this is not an example, this is a real life scenario. And if you want, you can just visit your nearby four-wheeler showroom and you will find that you have to pay some amount, you have to pay a booking amount, right? And you will get a delivery after 6 months, after 1 year, after 1.5 years. So if a customer is paying in advance just to secure the order, in that case, whether we need to compute the significant financing component, answer is no. You need to see that in this particular case, the customer is paying in advance only to secure the order. The entity is not asking for the advance. I mean to say, if customer will not pay the advance, of course, the order will not be secured, right? So the price of the car is 20 lakh rupees, 25 lakh rupees, and customer is only paying 50,000 rupees just to secure the order, right? So in this case, the significant financing component will not be there. So in the example, in your examination, you need to see what are the facts which is given in the question, right? If question says that the customer has paid the booking amount in advance, in that case, you are not required to compute any significant financing component. In that case, whatever consideration you will pay, that will be equivalent to the revenue which is going to be recognized, right? Second example. So in this case, what will happen? In this case, there will not be any answer. There will not be any there will not be any element of significant financing component. Okay, so you have to see the substance over form, right? Second example, Mr. Ram has hold 5% as a retention money of the contractor to ensure some quality related obligations. If the quality is up to mark, the same will be paid after 1 year. Friends, in this case, the customer is not paying 5% right away. The customer has hold as a retention money, the 5% of the amount, which is a normal business customary as well, right? You have audited many companies and even you have worked for few companies. If you have worked for few companies or if you have done the audit of many or few companies, you must have seen this retention clause, right? So if the customer is deferring the payment only to ensure some quality related obligation, in this case also there will not be any element of significant financing component. This is only done to ensure the quality. Okay, so this will not be considered as a significant financing component. Is it clear? So you need to see the facts also. Sumit, 1000 again. Sumit, the only thing is, first I have told you, of course it is kind of a discount. But why this discount has been given? This discount is only given because you have made the early payment and early payment beyond 1 year, right? So this is in the nature of a discount, which is kind of an interest income or interest cost, right? This is a discount which is kind of a interest cost. So again, you need to distinguish the nature of expenses. Is it a discount which has to be netted off with the revenue, or is it a discount which is in the nature of interest cost? This is a discount in the nature of interest cost, right? And that is why the revenue has been recognized at 100 rupees, 10,000 rupees, and interest cost has to be recognized at 1,000 rupees. And Sumit, tell me as an auditor what you will suggest. This is a single entity, and this entity is selling a goods A, B, and C, three different customer. The price of the goods is same. They have done the purchases from the same places. Everything is same, right? But the consideration is different for all the three customers. Why? Why? First customer is paying in time. So the entity is asking for 10,000 rupees only. The second customer is deferring the payment. The entity is asking for a higher money. The third customer is ready to pay upfront. Ready to pay upfront. But the delivery will be after 1 year. So that is why the entity has given a discount. But this discount is not in the nature of discount in the revenue. This is in the nature of interest cost. So the top line has to be 10,000, the revenue has to be 10,000, and the cost has to be 1,000. So Sumit, this is the guidance which is given in the standard, right? If this guidance would not have been there, probably what you are saying that was right. So whatever we are receiving, it should be recognized as a revenue. So going by your methodology, Sumit, even in the second case, revenue should be 12,000, not 10,000, right? So this is how significant financing component will play a picture here, right? I'm not saying that we will not recognize the revenue. We will not recognize the revenue from operation. We will recognize the interest cost or interest income. The top line should always be 10,000. Doesn't matter who is the customer and what is the mode of payment. I hope it is clear to all of you guys. I hope it is clear to all of you. Is it clear to all of you? Yeah. Good. Soham is asking, sir, if quality is not up to the mark, then will the entity reverse the revenue or edit as a cost? For example, the 5% money has been retained. Okay. So the entity has recognized the 100% revenue as a transaction price. Okay. And tomorrow, if the quality is not up to mark, then what will happen? In that case, revenue is going to be reversed in the next year. Or you can say that if in the next year there is no revenue, even you can recognize it as a cost as well. Okay. So Soham, you can do both the things. Right? Is it clear? Is it clear, friends? Shall I move forward? Good. So let me share my presentation again. Significant financing component we have discussed when there is a time value of money, right? The difference between the promised consideration and the cash selling price. So expected time between transfer of the promised goods and services and payment from the customer. Prevailing interest rate in the relevant market. So basically, how you will compute the significant financing component, you have to take the prevailing interest rate in the relevant market. You have to take the market rate of interest, right? And you have to also analyze what is the expected time between transfer of promised goods and the payment from the customer. Okay, so time multiplied by interest will give you the time value of money. Clear? I hope it is clear to all of you. Now let's discuss illustration number 38. NKT Limited sells a product to a customer for rupees 1,21,000 that is payable 24 months after the delivery. NKT Limited sells a product to a customer for 1,21,000 which is payable 24 months after delivery. So the price is 1,21,000 and the to sell a product to customer for 1,21,000. So the price is 121 which is payable after 24 months after delivery. The customer obtained control of the goods and services at contract inception, means the difference between the satisfaction of the performance obligation and the payment, I mean to say transaction price or the payment of the consideration is more than 1 year. It means there is a significant financing component exists. The contract permit the customer to return the product within 90 days. The product is new and the entity has no relevant historical evidence of product returns or other available market evidence. Okay. The cash selling price of the product is 1 lakh. Cash selling price is also given. So in this case, the consideration with this customer is 121. The cash selling price of the product is 1 lakh rupees, which represents the amount that the customer would pay upon delivery for the same product sold under otherwise identical terms and conditions at the contract inception. If the another customer will come and pay at the inception of the contract, the entity will charge 1 lakh rupees. But this customer is paying after 2 years, the entity is charging 1,21,000 rupees. The entity's cost of the product is 80,000 rupees. So 20,000 rupees is normal margin. The contract includes an implicit interest rate of 10%. The interest rate is also given in the question, right? Implicit rate of return, implicit interest rate of 10% means that is the interest rate that over 24 months discount the promised consideration of 1,21,000 to the cash selling price of rupees 1 lakh. Okay. Analyze the above transaction with respect to its financing component. So friends, in this case, the revenue is your 1 lakh rupees. Your interest component is 21,000 rupees. Your total consideration is 1,21,000 rupees. So how will you make the accounting entry? The accounting entry would be, these will be the accounting entry. Customer account debit to revenue 1 lakh rupees. At the end of the first year, customer account debit to interest income 10,000 rupees. At the end of second year, customer account debit to interest income 11,000 rupees. And at the time of collection after 2 years, cash account debit to customer account 1,21,000 rupees. So this is how this entry has to be done. Okay. Is it clear, friend? I hope it is clear to all of you. Clear? Yeah. Now let's discuss illustration number 40. Very important illustration. Illustration number 40. Right? Let me know if there is any query so far. Sumit is asking, sir, if whether the time value of money will only be applicable if period is more than 1 year. Yes, Sumit. ST Limited enters into a contract with a customer to sell an asset. So this entity has entered into a contract with a customer to sell an asset. Control of the asset will transfer to the customer in 2 years. Okay. So control of the asset will transfer to the customer in 2 years. That is, the performance obligation will be satisfied at a point in time. So when the entity will deliver this asset to the customer, only at that point of time, performance obligation will be satisfied. The contract includes 2 alternative payment options. And this ST Limited is offering to its customers two payment options. First option is either you can pay 5,000 rupees in 2 years when the customer obtains control of the asset, right? So at the time of delivery of the goods, you can pay 5,000 rupees. Okay, when you will obtain the control of the asset. This is the very I would say ideal situation. When you get a when you will get the goods and services, you will pay for those goods and services after 2 years, right? And today, payment of 4,000 rupees when the contract is signed. Today, since you are signing the contract, if you want to pay today, you can pay today 4,000 rupees. You can make an advance payment of rupees 4,000 rupees. And the customer has elected to pay 4,000 rupees when the contract is signed. See, 5,000 rupees is not the price of the goods and services which will be transferred today, right? The goods and services are going to be transferred after 2 years. And after 2 years, the price will be 5,000 rupees. Today's price has not been given, right? But an information has been given which says that if you want to pay today at the time of signing of the contract, you can pay 4,000 rupees only. And after 2 years, we will deliver these goods and services. Now, friends, don't get confused. The price of this goods and services today has not been given. The price for these goods and services for today, as of today, has not been given. If the price of the goods and services as of today would have been given, probably we will consider that price as a revenue, right? So the performance obligation is going to be satisfied after 2 years. And what is the definition of significant financing component? The definition of significant financing component is the difference between the consideration received. So basically, if the time period is more than 1 year, which is a difference between the time of the consideration received and the goods and services transferred. And what is the value of the significant financing component? The value will be the difference between price of the goods and services transferred today versus the actual consideration which we are receiving. Are you getting me this thing? The payment of 5,000 in 2 years when the customer obtains control of the asset, or payment of 4,000 when the contract is signed. The customer elects to pay 4,000 when the contract is signed. ST Limited concludes that the contract contains a significant financing component because of the length of time when the customer pays for the asset and when the entity transfers the asset to the customer, as well as prevailing interest rate in the market. The interest rate implicit in the transaction is 11.8%, which is interest rate necessary to make the two alternative payment options economically equivalent. However, the entity determined that the rates that should be used in adjusting the promised consideration is 6%, which is the entity's incremental borrowing rate. So which rate we need to be taken? We need to take incremental borrowing rate. We need to take 6%. We should not take this interest rate implicit in the transaction. We need to take the incremental borrowing rate, right? If I would not take 4,000 rupees from the customer, if I'll go to take this 4,000 rupees of funding from the market, I have to pay 6%, right? Pass journal entries and you are required to present how this entity would account for the significant financing component. Friends, you all agree that there is a significant financing component? You all agree? Yeah? You all agree or not agree? You all agree. Okay. So in this case, friend, first of all, the entity is paying in advance. So what will be debited at the time of contract inception? Cash account will be debited by 4,000 rupees. What will be credited? What will be credited? Cash account debit to contract liability or to customer account. To customer account. Cash account debit to contract liability or to customer, whatever you want to mention. And in the next 2 years, what you will do? You will recognize interest cost. You will recognize interest cost. Okay. You will recognize interest cost and you will recognize the credit to the contract liability or a customer, right? So in this case, how we will calculate the interest? 4,000 is the inception amount. So for the first year, 4,000 multiplied by 6% is your interest, which is 240. In the second year, again, we need to compute interest on 4,000 plus 240 because of course we are not settling to the customer, we are giving the goods and services at the end of second year, right? So 4,000 plus 240 multiply by 6%, it will give you how much? 4240 multiply by 6%. Can you do the calculation? So roughly it is coming out at 254. So in 2 years the total interest cost is 494. So the entity will debit interest cost debit because it is an advance case. Entity will debit interest cost debit 494 to contract liability or to customer. Right? Interest expense debit to contract liability or to customer by 494. So after 2 years, at the time of transferring goods and services, after 2 years, what will be the accounting entry? Since entity is not required to pay anything to the customer, so customer account will going to be debited. Contract liability or customer account will be debited by 4494 and revenue has to be recognized by 4494 and revenue has to be recognized by 4494. Is it clear to all of you guys? Is it clear to all of you? Yeah? Koshiki, is it clear? Rohan, is it clear? Radhika, Shivam, Ashwini, Avija, Aniket, Jyoti, is it clear to all of you? Guys, these are virtual session. If you will not respond, I would not be able to understand whether you have understood this concept or not. What is the catch in this question? In this question, the catch was the price after 2 years was given. Right? Today, the price after 2 years was given. So today you are entering into a contract and today you have to compute a transaction price. So what will be the transaction price of this particular thing? The transaction price for recognition of revenue is 4494. Right? The transaction price for recognition revenue is 4494. And what is the interest cost? It is 494. Okay. Good. Now let's discuss the concept of non-cash consideration. And let me go back to my Excel file. We have discussed that in case of a transaction price, computation of transaction price, the transaction price is impacted by 4 components: payable consideration, significant financing component, and non-cash consideration and consideration payable to customer. Let's discuss non-cash consideration. Non-cash consideration. What is the meaning of non-cash consideration? What is the meaning of non-cash consideration? So at times, friends, at times there is an exchange of goods and services. There's a barter. For example, there is a barter. For example, DLF Limited sells goods to sell freight to Mercedes in exchange of 2 cars. DLF Limited is into construction business. DLF Limited. What is the ordinary course of business for DLF Limited? DLF Limited. Ordinary course of business. Ordinary course of business is to sell flats. Is to sell flats. And what is the ordinary course of Mercedes Benz? Mercedes. The ordinary course of business for Mercedes is sale of cars. Sale of car. This is the ordinary course of business for Mercedes. This is sale of car. Okay. And in this case, DLF Limited sells flat to Mercedes in exchange of 2 cars. Now tell me how DLF Limited will recognize revenue. How? DLF Limited will recognize revenue in its books of accounts. Explain with the help of accounting entries as well. Right? Is it clear, friend? DLF Limited has not sold flats on a cash consideration, DLF Limited has sold flats on a fair value, right? And in the question, the fair value of the car is given. In the question, the fair value of the car is given. The fair value of one car is 2 crores. 2 crores. If these flats have been sold at a monetary consideration, then there was no any problem. We will recognize revenue as simple as that, right? But since instead of selling flat, DLF is getting some cars, which is a property, plant and equipment, which is a fixed asset for DLF. Okay. Now, what accounting guidance says that how to compute the transaction price? So, how DLF Limited will recognize revenue means at what value? At what value? Basically, instead of how, I should write at what value. At what value DLF Limited will recognize revenue in its books of accounts? That means what is the transaction price? Friends, the standard says that please remember this guidance. I'm writing the guidance here. Transaction price has to be computed in below manner. Transaction price has to be computed in below manner. What is that? First preference. You need to give the first preference. First preference. Sorry. First preference. What is the first preference? The transaction price has to be, the transaction price for the sale of flat will be fair value, or standalone selling price of the goods received. Whatever we are receiving, we have to recognize the revenue on the fair value of the goods received. Fair value of the goods received. Second preference, sir. Why second preference? If fair value of the goods and services received cannot be determined reliably, then fair value or standalone selling price of goods transferred. Why? Because this will always be there. DLF always knows what is the price, what is the fair value of the good flats transferred, because DLF is also selling the flats to the different customers, right? The first weightage has to be given to the goods received. So for buying two cars, what DLF Limited will pay? DLF Limited will pay the flats, right? So what is the value of those two cars which are coming in? So in this case, what will be the accounting entry in the books of DLF? The books of the DLF, in the books of DLF Limited, what is the accounting entry? The accounting entry will be car account debit by how much amount? 2 multiplied by 2 cars, 4 crores, to revenue, which is 4 crores. Okay. To revenue, which is 4 crores. Are you getting me? So this is the accounting entry in the books of the DLF Limited. In the books of DLF Limited, this will be the accounting entry. Is it clear? Is it clear to all of you? Yeah. So friends, in case of a non-cash consideration, the transaction price has to be determined on the fair value or standalone selling price of the goods and services received. If it is not measured reliably, then you have to go for the fair value of the or the standalone selling price of the goods and services transferred. I hope it is clear to all of you. Is it clear? Sir, subsequently there will be a change. So DLF has recognized the revenue, and after 6 months on the reporting date, the value of the car has gone down and there is an impairment. So of course, revenue will not be changed. The impairment will be as per Ind AS 16 or Ind AS 36. Impairment of asset standard or property, plant and equipment standard, right? So subsequently, the change in fair value has to be adjusted, has to be dealt in accordance with the respective standard, not in accordance with Ind AS 115. Ind AS 115 will play a role in calculation of transaction price at the time of inception of the contract. Once revenue has been recognized, the contract is over, right? Now that item which have been received by DLF Limited, that any changes in the value of car has to be dealt in according to the respective standard. I hope it is clear to all of you. Yeah. Good. Let's discuss illustration number 48 to understand this concept. Entitlement to a non-cash consideration. An entity enters into a contract with a customer to provide a weekly service for 1 year. Okay. So every week, this entity has to provide a service. The entity has to provide a service for 52 weeks. The contract is signed on 1st April 2001, and the work begins immediately. Okay. The entity concludes that the service is a single performance obligation. So this is a series of distinct goods and services. So this is a single, and it concludes that it is a single performance obligation. This is because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. You remember, I have taken an example of newspaper agency. I have taken an example of electricity. I have taken an example of security guard. Have the same pattern of transfer. The services transfer to the customer over the time and use the same method to measure the progresses. That is a time-based measure of progress. Like electricity bill, you will get every month, right? So it is a time-based measure of progress. Security guard you are paying every month. Employee will get the salary every month and he is providing a services every day, right? So this is a time-based measurement of progress. Okay. In exchange for the service, the customer promises its 100 equity shares per week of the service. See, the customer is not paying the money. The customer is giving its equity shares, 100 equity shares per week of a service, a total of 5,200 per shares for the contract. The terms in the contract requires that the shares must be paid upon the successful completion of each week of service. Right. So the terms in the contract require that the shares must be paid upon the successful completion of each week of service. So whatever is the total services completed, on that basis, equity share is required to be issued. Now the question is, revenue has to be recognized at what value? What is the transaction price? So friends, in this case, the transaction price has to be on the fair value of the goods and services received. So what we are receiving? We are receiving equity shares, right? So what we will do? We will debit it, equity shares or investment in the customer account debit to revenue account. Sir, tomorrow, if the value of the investment goes down or goes up, then what will happen? In that case, you have to treat this as per the provision of Ind AS 109, okay, or the respective standard. I hope it is clear to all of you. The entity measures its progress towards complete satisfaction of the performance obligation as each week of service is complete. To determine the transaction price, the entity has to measure the fair value of 100 shares that are received upon completion of each weekly service. The entity shall not reflect any subsequent changes in the fair value of the shares received or receivable in revenue. Okay. I hope it is clear to all of you, friends. Sumit is asking, sir, loyalty points can be a non-cash consideration. So Sumit is asking, sir, for example, on every purchases, when we do the purchases from Big Bazaar, when we do the purchases from, let's say, Reliance Mart, when we do the purchases from Louis Philippi, or let's say Ellen Solly, we are getting a loyalty points every time. And these loyalty points will be redeemed for the future purchases. So what we are required to do, is it a non-cash consideration? These loyalty points is not a non-cash consideration. Right? These loyalty points will be like a discount which is given for the future purchases. This is like a separate performance obligation. And that is why if you will see these kind of industries, right, where they are giving a loyalty points to the customer, like retail industry, like FMCGs, right? So they are creating a provision for loyalty points, right? You remember in our discount voucher, we have recognized 107 rupees of a refund liability to the customer or liability relating to the future discount. So likewise, these companies are also creating a provision for loyalty points, right? It is not a non-cash consideration. Non-cash consideration means you are not getting a cash, you are getting something else. Yeah, I hope it is clear to all of you, friends. So friends, since tomorrow, not tomorrow, sorry, since morning, we have discussed the concept when there is a right of return, right? So to the extent or till the period of right of return, we have to recognize the revenue to the extent of the goods and services which is not expected to be returned, of course on the basis of past estimates, on the basis of past precedents. Okay, then we have discussed option for material right to discount. When the customer is entering into the contract with the entity, and due to that contract, he is getting a right to additional discount in future. So that will be considered as a separate performance obligation, and transaction price has to be allocated to that separate performance obligation, and the revenue relating to that discount voucher will be recognized in future, right? Either when the future purchases will happen or when the time period for the discount will be elapsed. Then we have discussed the step number 3, which is determination of transaction price. What is the transaction price? Transaction price is the expected amount which is going to be collected by the entity in exchange for goods and services, and it excludes the taxes or it excludes anything which is collected on behalf of the third parties, right? Then we have discussed, friends. So friends, we have discussed 3 examples, one of GST, one example of, we have discussed the expected collection of that 10 lakh rupees versus 6 lakh rupees, right? So we have discussed all these aspects. Then we have discussed that transaction price could be a fixed consideration as well as variable consideration, right? So example of the variable consideration could be, for example, the entity is getting some incentive, the entity is getting some bonus, the penalties, right? So these are the examples of variable consideration. Volume discount in case of FMCG business. Again, it is an example of variable consideration, right? Then we have discussed the example of significant financing component. That what is my significant financing component? Okay. So we have discussed that part also. That if the time value of money is material, I mean to say the difference between the timing when the money is received and the goods and services have been delivered is beyond 1 year, is more than 1 year, then we can say the time value of money is material, right? As per Ind AS 115. And what is the value of the interest? What is the value of the financing component? The value of the financing component is equal to price of the goods and services. The price of the goods and services transferred to the customer versus the actual consideration received from the customer at the same point of time, right? So this is the difference of this is the meaning of significant financing component. And we have discussed what is the significant financing component, how the treatment will be there in case of deferred payment, in case of advance payment, or in case of on-time payment. And we have also discussed if the payment is going to be made in advance only to secure the delivery or secure the orders, like in case of automobile booking, right? So this will not be considered as an advance. So if you go to buy a Mahindra car, there is a booking for more than 1 year. There is a delivery timing for more than 1 year, because now these companies have make this as a business model, that whatever order will come, whatever the bookings will come, we will manufacture only those number of cars, right? So if the customer is holding a money as a retention for the ensuring some quality or performance bonus, quality or performance, right? In that case, it is again not a case of significant financing component. When we discuss non-cash consideration, when the entity is providing some goods and services, providing some promised goods and services, delivering the performance obligation, but entity is not getting cash, entity is getting some goods and services in return. This is an example of non-cash consideration, right? So let me look at if any query is there. Please let me know if any query is there. Okay. So friends, let me conclude the session for the day, right? So tomorrow is the last and the 4th class of this standard. So tomorrow we will cover the last 2 steps, and along with the along with the cash payable to the customer, right? So along with the consideration payable to the customer. So the last 2 steps are the first 3 steps were very big steps, but the last 2 steps were very small steps, right? So tomorrow we'll cover the step number 4 and step number 5, and we will also cover the consideration payable to customer. I would request all of you that please go through with the with the classes which is there on the YouTube, which I have taken on 22nd February, 24th February, 26th February, on 3rd March, and on 5th March. So I would request you guys to please go through with those classes so that you will be able to understand the concept very well. Although I am explaining the concept, and I am also uh, trying to keep the same examples which I have taken in my earlier classes, right? So I'm also keeping the pattern of classes as a same pattern what I have taken in the month of February and March in this year, right? So that whenever you will refer those classes and you will also refer these classes, it will help you, it will add you in kind of a revision of the earlier classes as well, right? But of course, since the time period is less, so we will have a limited discussion in these classes. As far as concept is concerned, we will do the complete discussion on concept, but as far as the practical examples are concerned, as far as the study material case studies are concerned, we will do the limited case studies, right? Thank you so much, friends. So with this, I want to conclude this session, and we will meet tomorrow for the conclusion of Ind AS 115. Thank you so much. Bye bye. Take care.